Let's bring in now DoubleLine Capital CEO and CIO Jeffrey Gundlach. Jeffrey, welcome back for our traditional visit.
Hey, Judge. Good to be here again.
It's good to have you. So what is your reaction to what the Fed chair had to say today? He used a couple of R words, the one we talked about last time, recalibration, and then remarkable, he said, when describing the resiliency of this economy.
Yeah, recalibration showed up again, and that's a repeat of the last meeting's sort of word of the meeting. And I think Powell feels very much that he's in a good place now, because since the July 31st meeting, we have the two-year Treasury rate is up by almost 60 basis points, and the Fed funds rate is now down by 75 basis points. So he's gotten much more in sync with the bond market by a movement of Fed funds relative to 2 years of 135 basis points of convergence in just basically two meetings. So I really think that we probably have one more rate cut coming in December, because that would true up the Fed funds rate with exactly where the two-year Treasury rate is right now. So it is interesting that we've had such a strong performance of the stock market since the last Fed meeting, while we've had interest rates rising. So you've had a tremendous outperformance of stocks versus at least Treasury bonds since the last Fed meeting, and I attribute that basically to the election result. So we had an incredibly consequential election result, very different than a lot of people probably were forecasting as a base case a few months back. And we've had one of the least consequential Fed meetings today, with basically a repetition of this idea that the goals are normalizing, the labor market's normalizing, the quits rate and the job openings rates are kind of where they were pre-pandemic. And so I think the Fed is feeling very much that they are plodding along towards their goals, and he said so in fairly direct language today. So yeah, the thing that's sort of surprising me a little bit is that people are so willing to dismiss the softening jobs market. I mean, the 12,000 jobs, I know people want to attribute that to one-off hurricanes and strikes and stuff like that. But I keep looking at the household survey, and the household survey over the last 11 months has been a loss of jobs of over 300,000 jobs cumulatively over the last 11 months. And so that typically is a little bit more real time at economic turning points. It's still not terrible, the household survey. It's very volatile, so we have to watch out for that. But it is not showing tremendous signs of strength. And the real problem that the bond market seems to be having, from my perspective, and it's being talked about much more in the open, it came up several times at the press conference today, is that the supply of Treasury bonds is getting to be rather astonishing. We have a $2 trillion deficit. It's about 6% of GDP over the last 12 months, and we still have a growing economy. And the interest expense on the debt, which I always talk about, 3 years ago was $300 billion per year. It's now $1.3 trillion per year. And we have a great volume of bonds that are rolling off with very low interest rates from 5 years ago, or even 3 years ago, that are being refinanced at substantially higher rate levels. And this is going to continue to be a supply problem for the bond market. And for this reason, we are not positive on long-term Treasury bonds, in spite of the fact that the economy is sort of gradually slowing down. It's just the supply of bonds is very troubling. And so we recommend investors stay at the intermediate part of the Treasury bond market and not out in the 20 and 30-year bond sector. In fact, when we were at the low in rates, basically several weeks ago, we made another duration cut or maturity cut in many of our bond funds, because we do not want to be exposed to this fiscal financing problem, which I think could very well lead to rising interest rates in spite of the fact that we might have a slowing economy. So interest rates are rising. We have the curve is not inverted anymore, 2s to 10s. It's not very positively sloped. It's a very flat yield curve, and we're anticipating that the Fed will cut rates again in December. So not a lot to take away from today's meeting. It was pretty much a repeat of the comments that were made by Jay Powell at the last meeting. But I do think that he is much more in line with the bond market, and he is correct in exuding the idea that he's a normalized sort of a place, and that he's making progress towards the mandate. The inflation numbers are lower, of course. The PCE core is at 2.7. There are some inflation numbers in the low twos. We believe that if we keep the price of oil around the low 70s, which has been a lot of resistance down at around 70, we think we're going to see potentially a headline CPI that's below 2% in about 4 or 5 months, based upon the structure that's there. So Jay Powell will be able to pretty much declare a victory. I also commend Jay Powell for bringing up the lags on the rent rolls. The part of the inflation rate that remains elevated is kind of rent rolls. The new rents have almost no inflation, but the old ones, they come down with a lag. And so that part of the inflation picture is probably still going to provide something of a ceiling on where the inflation rate is going to be for 2025. I don't think under the base case we'll see a 3-handle CPI inflation rate during the next 12 months.